Tax deductions in 2024. Strategic insights for accounting professionals in an ever-evolving tax landscape. Staying updated on available tax deductions is crucial for accounting professionals. With new regulations and adjustments each year, understanding which expenses qualify as deductions can significantly impact clients' financial health. The importance of accurate deduction tracking extends beyond compliance. It also plays a pivotal role in optimizing client finances. As accountants navigate complex tax codes, identifying legitimate deductions becomes essential for maximizing savings. Federal Income Tax Deduction Overview. A federal income tax deduction reduces taxable income by allowing taxpayers to subtract eligible amounts from their gross earnings. This mechanism effectively lowers the amount subject to taxation, potentially reducing overall tax liability. Deductions can be either itemized or taken as part of the standard deduction. Itemizing provides greater flexibility but requires careful documentation of all qualifying expenses. The IRS establishes annual limits that define what qualifies as a valid deduction. These limits ensure fair application across different taxpayer categories while maintaining revenue integrity. Commonly allowable deductions include mortgage interest, charitable contributions, medical expenses exceeding certain thresholds, and state/local taxes, subject to limitations. Mortgage interest. Up to $750,000 loan amount qualification threshold for primary residence. Charitable contributions must have official receipts and not exceed adjusted gross income percentage limits. Medical expenses. Only those above 7.5% of AGI are deductible after 2023 state/local taxes, cap at $10,000 combined for property, income, and sales taxes. Business expense deductions for self-employed individuals. Self-employed individuals must maintain thorough records of all business-related expenditures. The IRS mandates that deductions directly correlate to business operations rather than personal use. Keeping detailed logs including dates, amounts, descriptions, and purposes ensures audit readiness. Electronic systems often provide better organization capabilities than traditional paper methods. Deductible items range from home office space allocation to professional development costs. A clear distinction between business and personal use remains critical. Vehicle usage presents particular challenges due to necessity of determining actual versus standard mileage rates. Documentation requirements increase proportionally with vehicle value. Certain software subscription fees may qualify for full or partial deduction depending upon their direct connection to business functions. Always consult current guidelines before claiming such deductions. Professional development expenses such as seminars or certifications typically offer full deductibility when primarily aimed at enhancing job skills related directly to current work activities. Retirement account contributions and tax benefits. Contributing to retirement accounts offers dual benefits through both pre-tax and post-tax contribution options. Traditional IRAs allow immediate reduction of taxable income during contribution phase. Roth IRA contributions differ by offering tax-free growth potential despite initial non-deductible status. Choosing appropriate type depends heavily on individual circumstances. Employer-sponsored plans like 401(k)s present additional advantages including matching contributions which essentially represent free money towards future security. The Secure Act has introduced changes affecting required minimum distributions starting in 2022, altering long-term withdrawal strategies for many retirees. Varying contribution limits exist annually based on inflation adjustments and legislative decisions made prior to calendar year beginning. Staying informed maintains optimal benefit utilization. Educating clients about these options enables accountants to guide them toward most advantageous retirement planning structures tailored specifically to their needs. Education credits and scholarships for tax planning. Education credits serve as powerful tools within comprehensive tax strategy frameworks. They function differently from regular deductions by providing direct reductions against calculated tax liabilities. The American Opportunity Credit allows up to 4 years of eligibility covering tuition and course materials costs incurred by undergraduate students. Lifetime learning credit applies broadly across various educational pursuits without restricting participation duration. It covers ongoing education expenses even after degree completion. Scholarship income generally exempt from taxation provided it's used exclusively for qualified educational purposes defined under applicable statutes. Special attention should be given regarding stipends received through work-study programs since portions might become taxable depending upon nature of services performed. For college-bound families, calculating potential credits early helps identify significant savings opportunities well ahead of filing deadlines. Healthcare premiums and medical expense deductions. Qualifying healthcare premium payments often represent substantial annual deductions, especially relevant considering rising insurance costs nationwide. Understanding eligibility criteria proves vital. Premiums paid under employer-sponsored group coverage do not count unless self-only plans were selected outside workplace offerings. Distinction matters greatly regarding claimability. Individual market purchases usually permit full deduction provided they meet minimum requirement benchmarks established by regulatory authorities. Out-of-pocket medical expenses require exceeding specified percentages relative to adjusted gross income before becoming deductible. Threshold levels change periodically, so vigilance is key. Prescription drug costs fall under broader category requiring coordination with other related expenditures whenever calculating final figures. Dental care procedures vary in categorization, with some types classified separately from general medical treatments needing special treatment during calculations. Investment-related deductions and losses. Tax losses associated with investment portfolios can offset capital gains, creating meaningful reduction possibilities. Proper classification determines applicability scope. Holding periods dictate whether realized losses count as short-term versus long-term, impacting eventual offsets permitted within regulations. Wash sale rules prevent attempting to manipulate loss recognition timelines through strategic purchase resales soon thereafter. Deductible investment management fees relate specifically to advisory services offered professionally. Distinguish clearly from typical brokerage transaction charges. Foreign tax credits sometimes apply depending upon nature of international investments maintained by clients seeking optimized global positions. Documentation relating to trades, including trade dates, security names, quantities traded, and price information, remains absolutely necessary should audits occur. Real estate investors and property-related deductions. Active real estate investors enjoy numerous deduction avenues unavailable elsewhere within tax code structure. Thorough record-keeping becomes particularly crucial here. Depreciation schedules calculate annual deductions using straight-line method over designated recovery periods varying according to asset classifications. Interest expenses on mortgages tied directly to rental properties count fully as long as properties remain legally rented out consistently throughout period considered. Repairs versus improvements distinction affects how funds get categorized, leading ultimately to differing deduction results requiring precise judgment calls. Property taxes assessed locally constitute legitimate deductions, limited however by caps applied uniformly across regions experiencing similar constraints. Maintaining separate bank accounts dedicated strictly to real estate ventures simplifies tracking, immensely facilitating smoother reporting processes later on. Home office deduction calculation methods. Employees utilizing home offices receive limited deduction privileges compared to independent contractors who own their businesses outright. Different calculation approaches emerge accordingly. Two primary methodologies apply depending upon user classification. Simplified option using square footage multiplied by IRS prescribed rate, or detailed computation involving rent/mortgage portion allocations. Landlord-tenant scenarios create complexities because determination hinges upon whether occupant utilizes space solely for business versus shared living arrangements. Utility cost apportionments necessitate proportional distribution between personal consumption areas and officially designated workspaces within same dwelling unit. Determining correct percentages relies upon physical layout characteristics combined with frequency data showing where majority time gets spent performing duties remotely. consultation with experts becomes advisable, particularly concerning high-value properties where minor miscalculations could yield notable discrepancies affecting bottom lines adversely. Tax preparation strategies for maximizing deductions. Strategic organization remains fundamental aspect, enabling successful identification and substantiation of possible deductions throughout entire fiscal cycle. Maintaining centralized digital repositories facilitates quicker access during busy season, allowing timely responses regardless changing situations encountered along way. Regular periodic reviews help catch emerging trends or alterations that might affect existing claims, making adjustments easier proactively rather than reactively. Engaging specialists specializing in niche areas enhances accuracy, ensuring nothing worthy slips past notice unintentionally overlooked amid complexity faced daily. Utilizing automated tracking solutions streamlines monitoring efforts, reducing manual entry burdens while improving data reliability simultaneously. Planning ahead permits better anticipation of upcoming events, influencing eventual outcomes, thereby increasing likelihood achieving favorable positioning beneficial all parties involved. Conclusion: mastering modern tax deduction nuances empowers accounting professionals to deliver enhanced service quality, characterized notably by meticulous attention directed toward every aspect covered comprehensively herein. By remaining current with evolving standards coupled with employing advanced analytical techniques regularly employed, industry leaders achieve superior results, distinguishing themselves competitively within field occupied.